This is the catalyst we had all been waiting for. The Fed has recently come out with a fantastic report documenting the FOMC meeting from June that has left the stock market with a bombshell news report that is leading stocks very much in the upwards direction. In this video, I want to give you guys a summary of what the meeting minutes said and how they show us inflation actually potentially peaking within the next 2 quarters, which is obviously going to act as a major catalyst for the stock market. I'm also going to explain how this could affect our growth stock portfolio, which has obviously gotten hammered over the past few months. I'm sure you guys are really going to enjoy this video, so make sure you watch all the way to the end. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So the first thing we want to address is what exactly was mentioned in the FOMC meeting minutes. Well, the main thing I saw reading through this entire report was that GDP expectations for the next few quarters and into 2023 are going down. Now, in my opinion, this should not be of surprise because interest rates going up does bring down aggregate demand. And obviously, since 2021 was extremely hot, it's no surprise that the economy is going to cool down a little bit. And like I've said in the past, this is only going to be a paper recession for the second quarter if GDP data comes in negative, meaning the underlying economy on Main Street is doing just fine because obviously inflation is high. Instead, the only recession we're really seeing is that output has gone down a little bit, and obviously in the tech sector, we are starting to see layoffs and job freezes, which obviously is indicative of a recession. But it's also important to keep in mind that the tech sector was also extremely hot in 2020 and 2021, so it does deserve to cool down. But regardless, the most important part of this FOMC meeting minutes report, in my opinion, is right here. As you can see, the Fed mentions that market-based measures of inflation compensation continue to indicate expectations that inflation would decline notably in the coming quarters. Now, the main reason that this is happening is because the 5-year break-even rate for treasuries is actually going down. And as we all know, that tends to lead CPI and PCE inflation data. And since last week, PCE data already came in well below analyst expectations. In my opinion, that is a pretty bullish thing. And if you pair that with the fact that July historically has been a pretty good month for stocks, as seen through this data that was compiled through 1928, it's pretty easy to see why the market is going up. Now, sure, this could just be a bear market rally, and if CPI on July 13th and the FOMC meeting on July 26th come out with really poor data where the Fed all of a sudden raises by 100 basis points and CPI prints at over 9%, then yes, this is going to be just a fake out rally and the market's going to head lower. But in my opinion, that's not what I want to bet on. I want to bet on inflation falling and these recession fears already being priced into the market, because inflation and recessions are opposite of each other. They tend to cancel each other out. A recession is a deflationary event. And so if we're going into recession and if we're already in a recession, that is good for bringing down inflation, which is the Fed's main concern. And as you can see, the ISM manufacturing data also came out today, and clearly it's showing that we have peaked and that production is starting to slow down a little bit, which is a good sign because it shows that client and demand is starting to fall. And as you can see, this index peaked in early 2021, which is also when inflation started rampaging higher. And so this going down is also a good thing. It means that the Fed's actions are actually taking place. Now, following that, another critical thing the Fed mentioned is the fact that the labor market is tight, but there are signs of it slowing. Now, keep in mind that this is the second prong that the Fed really cares about. They want to bring down inflation, but they also want to bring it down while cooling down the labor market so that there is no wage price spiral, which would lead us to a never-ending situation of high CPI. And so this slowing is another bullish catalyst for stocks. It's these very fine prints in this report that really show us how the story is playing out. The bigger picture all of the time is going to look very bad, right? The articles out there and the Fed and the meeting minutes and the recession fears are all going to look quite poor. But the reality is that at some point there is going to be a pivot. The Fed's actions are going to affect inflation. And we want to see how that plays out through the meeting minutes, through the summary of economic projections, and obviously through the data. But the key thing to keep in mind is that throughout this entire event, at some point the market is going to stop caring about what's happening, because at some point everything gets priced in. The data is going to still look bad, maybe in the next few quarters, but the stock market at some point is going to stop reacting to it. And why that's the case? Well, because simply there is nobody else left to sell. Now, I'm not saying that this is going to be the bottom for the market, and it could certainly go lower if data comes in even poorly. But as for what we already have in the market right now, if you're basing your investment thesis based on short-term media headlines about recession and this and that, then you're not going to really make it as a long-term investor. And I think we need to keep that in mind in the bigger picture. You always want to be fearful when others are greedy and buy stocks when others are fearful. And most retail investors, in my opinion, right now are extremely fearful. These are the same people that were probably buying stocks back in 2021, but now they want to sell stocks, even though we know that in the long term, the market always goes up. These retail investors are basically programmed to tell us exactly what the market's doing today, not where the market's going to go in the future. And so just keep that in mind if you are going to really take these media headlines to heart. But regardless, if we continue on with what the Fed meeting minutes mentioned, as you can see, another critical part of this was that production and spending indicators were mixed, but generally remained strong. What this shows is that the underlying economy from a production standpoint is improving. Right, production is what's going to bring down supply chain issues, and that's going to bring down the PPI index, which is the producer price index, which in turn is going to bring down costs and increase inventories. And that is going to be another catalyst to bring down inflation and another catalyst to keep the stock market going higher. This actually resulted in real imports of goods to be stepped back from April in the US. This is another good thing. This means that client and demand is starting to fall as interest rates are going higher and as people get into this cash crunch situation from all the stimulus checks that we distributed throughout 2021. But regardless, I think overall, this is a pretty bullish report. Now, yes, in the surface, situation could get different, and in a few months' time, the meeting minutes could be extremely hawkish and the Fed raises by 100 basis points. But regardless, let me know down in the comment section what you guys think of this report. And one of the key catalysts I want you guys to keep in mind for next week is going to be the CPI data that's going to come out on July 13th. This is going to be a big market mover. Now, just because this goes high doesn't mean that inflation is going to go run away, because the Fed's actions at some point are going to take effect. But just keep in mind that if you're day trading or swing trading, this could have an effect on how the market performs. And then following that, the other thing to keep in mind is the July 26th FOMC meeting, which again should give us more direction on where the Fed is going to go. But just keep in mind that in the long term, these interest rates are not going to really affect the value of your stocks that you're buying today. And I would definitely take advantage of some of the deals we're seeing in this market because they are not guaranteed to last. But as usual, guys, I hope you enjoyed this quick video, and I'll catch you guys in the next one. Take care.